Hi, I'm Tom Bradley, President of Steadyhand Investment Funds. Today I have with me Brian Eby, who's Vice President and Director of Connor Clark and Lunn Investment Management. And Brian heads up the fixed income team at CC&L. CC&L is the manager of our savings and our income fund. And today, as well as talking about Connor Clark and Lunn and a bit about that firm, Brian and I are going to talk about the structure and objectives of the income fund. Brian, welcome. Delighted to have you here.
Thanks, Tom.
Now let's start with a quick overview. Maybe you could give us some background on Connor Clark and Lunn.
Well, Connor Clark and Lunn was founded in 1982 here in Vancouver by Larry Lunn, and has evolved to what is now the largest privately owned investment group in Canada. We have over $50 billion in assets across a variety of strategies. And despite our scope and scale, our culture remains very entrepreneurial. We remain very proud of our independence.
We like that at Steadyhand. Well, maybe you can give me an overview of sort of your team and how you approach managing the income fund. You guys have had a great reputation in fixed income for many years. I've butted heads against you in the past, but maybe we can start with just sort of a broad overview.
Okay, so for fixed income investment management, or to manage a fixed income portfolio well, you really need to do a number of different things. So there's, for example, macroeconomic forecasting in order to forecast interest rates. Credit research, so the analyzing businesses and balance sheets, so that we can determine which corporate bonds to buy, which is really another way of saying what companies we want to lend money to. We need experienced bond traders. There's the process of buying and selling bonds is a bit unique. We don't have a stock exchange or an exchange to transact in. And so what we've done is we've organized our team along these different functional areas, recognizing that each area requires a very different kind of skill set. And each area is headed up by a senior partner at Connor Clark and Lunn. And then really the critical issue is taking these very diverse skills in this diverse group and working quite collaboratively to come up with a cohesive portfolio strategy.
Well, now you're a bond guy, you're immersed in interest rates, credit spreads, basis points, all that kind of stuff. Maybe if you can, try and take us sort of up a level, maybe simplify it a little bit, and just talk about the bond portion of the income fund first and how you manage that, how you bring all of those parts together.
Really, Tom, what it comes right down to is trying to identify the best sources of return for the least amount of risk. And so, for example, identifying what term or maturity along the yield curve offers the best value, which sector in the provincial market, the corporate market, offers the best trade-off between return and risk. And then at the individual company level, which companies and which securities specifically offer the best value.
Okay. Well, you and your team, Scott and I, collaborated when we designed the income fund, and at the time it was actually quite different than most other things out there. It's been copied since then, but we wanted to make it more than just a standard bond fund, indeed a bond beater, which it has been. So to do that, we've got dividend-paying stocks, we've got real estate investment trusts or REITs, and from time to time we have high-yield bonds. Maybe you could take us through those three components, which are a little different than the core government and
Yeah, what we're really looking for there is basically long-term, stable, relatively predictable cash flows with some preservation of capital through it, so that we're getting the cash flow without any deterioration in the capital value of the security, basically at its heart. And what that does for the portfolio is it allows us to get a better yield or a better return, but it also gives us some diversification benefits. So all of these investments do have some sensitivity to the change of interest rates, but less so than a traditional bond. So if interest rates were to move higher, these securities won't be quite as impacted as a typical bond.
Now, we've designed the fund to be sort of a long-term target of 75% bonds, 25% equities. Maybe you could comment on that mix, and we've given you the scope to make changes. So what drives those changes?
So that mix of 75-25, that's where we would expect to be on average, over the long term. But what we have been and what we continue to expect to be is pretty active in managing amongst the various investment asset classes, if you will. And we're going to be looking for relative valuation, relative opportunity, but also our assessment of the overall risk environment. We can go as low as 60% bonds and as high as 100% bonds.
Maybe to wrap up, Brian, we could just talk about how volatile you expect the fund to be and what kind of investors it's suitable for.
So we do expect this fund to be more volatile than a typical traditional government bond fund. And that's the trade-off for it being a bond beater. We also expect over the longer term the returns to be better than a traditional bond product. What we think it's suitable for is an investor who's looking for long-term, diversified source of income and a return that will outpace inflation, but really an investor with an investment time frame of at least 3 years.
Okay, that's good, Brian. Well, thank you. This is a good overview, and we look forward to having you keep doing that good work on the Income Fund. Thank you.
Thanks, Tom.